Now, we all know that a company has various classes of share capital that it issues to its shareholders. Sometimes what can happen is that a company may have surplus funds which it cannot deploy for useful purposes or business purposes. In those cases, the company can do is they can buy back the shares from the shareholders and return them some part of the money that the company has been able to generate through its business. This is something which is called in simple terms as buyback of shares. So in this particular case, if I just go back to the diagram, if XYZ has a share capital of 10,000 shares, it can actually buy back 1,000 shares from its shareholders. These shareholders can be resident investors. These shareholders can be non-resident or foreign shareholders. Now, the question that comes up is that if such is the situation, how will the tax work on buyback of shares? This is something which is covered in section 115 QA of the Income Tax Act. There are two events which are happening in this case. One is the company is buying back the shares, and two, the shareholders who are owning these shares are literally transferring their own shares to the company for cancellation purposes. When we talk about tax, the tax on buyback of shares is something which is payable by the company and not the shareholders. So when we talk about 115 QA, what it mentions is that whenever there's a buyback of shares, the company which is buying back the shares has to pay tax at the rate of 20% of the distributed income. Now, the question that again comes up is what exactly is distributed income? Let's look at an example to consider this aspect. So XYZ purchases its equity shares from Indian and foreign shareholders at 200 rupees per share. In other words, the selling price is 200. The amount received by XYZ Private Limited was rupees 100 per share. Now, what the section provides is that in order to calculate the distributed income, what we need to do is from the selling price or the buyback price, we need to reduce the amount which was received by the company for the issue of shares, right? In this particular case, we've taken it as 100. Now, this is a complicated matter. There may be different situations and circumstances when this might be applicable. All those circumstances, you need to watch out for a relevant rule, Rule 40BB, if I recall it properly. That's the rule which lays down how you have to calculate the amount received per share. But for simplicity purposes, let's say it's 100. So the amount of distributed income will be 100. And on this 100, tax at the rate of 20% will be payable by XYZ. Once this tax is paid, whether it's the Indian shareholder or the foreign shareholder, they are not required to pay any further tax on the transfer of these shares and the receipt of this consideration.